Welcome to the Deep Dive, the show engineered to cut through the noise. We take your stack of confusing sources and deliver the critical analysis you need to be the most informed person in the room.
And today, we are wading into a truly fascinating mess. The start of the 2026 trading days. Our sources show a global economy that's, well, it's moving at two wildly different speeds.
Right. On one hand, you have these huge policy pivots. We're talking tariff delays, regulatory rollbacks, central banks under a ton of political pressure.
And on the other hand, you've got these deep structural market transitions. The Buffett era is formally over. Critical minerals are basically being weaponized.
And there's a huge new tax liability that just slammed into consumers on January 1st. So our mission today is to pull out these threads so you can see the risks, the hidden value, and really separate the signal from the noise.
What's so interesting is how sentiment just splits depending on where you look. There's real optimism in stocks and certain commodities, but the foundations, U.S. debt, household balance sheets, they're showing some pretty deep fault lines. Let's start with the foundation, the bond market.
Okay, let's unpack this with the Fed's tightrope walk. The benchmark 10-year Treasury yield, it rose over 3 basis points on the first trading day, settling at 4.191%.
The 2-year went up a little bit too.
Yeah, to 3.475%. And just a quick reminder for anyone tracking this, yields and prices move oppositely. So a small yield increase means prices soften just a little to start the year.
But that 10-year yield, that's the key data point. When it rises, it usually signals that investors are expecting stronger growth and maybe more inflation risk.
But the policy context here makes this so complicated.
Exactly. The last FOMC meeting was incredibly divided. I mean, they approved a quarter-point rate cut, but the vote was 9-3. That's the most dissent we've seen since, 2019?
That division is the real story here. A 9-3 split that signals this deep internal conflict at the Fed. Are they more worried about inflation risk or employment risk?
And the official minutes say both. They explicitly warned about downside risk to employment, but at the same time, upside risk to inflation. They're caught.
And this matters directly to you because the market is pricing in multiple rate cuts this year, right? Maybe 2, maybe 3.
But the Fed's own projection, the divided board, is for only one cut. That gap between what the market wants and what the Fed says it will do, that creates huge volatility risk, especially with the next decision coming up on January 28th.
Okay, so how did that translate into the stock market on day one? It was pretty mixed. The S&P 500 closed a little higher, up 0.19%.
But the NASDAQ slipped just a tiny bit, 0.03%, but still.
Right, and this continues that bifurcation theme we saw all through the back half of 2025.
Bifurcation is the perfect word for it. The strength was really concentrated. Chip stocks, I mean, they were just soaring on that whole generative AI infrastructure boom. NVIDIA was up over 1%. Micron Technology popped more than 10%.
And let's dig into that Micron number for a second. Why a 10% jump?
It's all about HBM high bandwidth memory. It's a very specific, super fast memory that you absolutely need to train these massive AI models.
So it's not just about selling chips anymore. It's about selling this specialized gear that is the current bottleneck for AI. A 10% jump in Micron tells you the market is betting big on that infrastructure spending.
And you contrast that with software stocks, which took a hit. Salesforce, for example, was down over 4%. It really suggests investors are rotating out of software and into the hardware needed for this next tech phase.
And we should remember, despite the mixed start, 2025 was a great year. S&P was up 16.4%, NASDAQ jumped 20%.
Globally, the picture was even stronger. South Korea's Kospi hit a record high, up over 2%, mostly because Samsung Electronics surged 7%.
Also on that HBM chip praise.
Exactly. And Europe, wow, Europe tells a powerful story. Italy's market had its best year since 1998, up over 31%. But the real standout was the defense sector.
The numbers are just unbelievable.
Stocks like Saab, Rank, Rheinmetall, they closed out 2025 with annual gains between 130% and 193%.
It's just massive. That military spending driven by global tension is clearly driving investment. And that tension is, well, it's the perfect bridge to our next segment. The resource crunch.
It is. Geopolitical tension drives defense stocks, and it also drives people to hedge with precious metals. First, the dollar. It started 2026 a little bit stronger, but that's after it got hammered in 2025. It had its steepest annual decline since 2017.
And BCA research is still calling the dollar deeply overvalued.
Yeah.
So that weakness, plus all the instability, unrest in Iran, the Russia-Ukraine conflict, it drove this incredible surge in precious metals.
Staggering is the right word. Silver was up 147% in 2025. It hit an all-time high of $83.62 an ounce. That's its best year since 1979.
Gold was up 64%. This isn't just a retail fad. This is smart money hedging.
And here is where policy turns this into a full-blown strategic conflict. On January 1st, China started restricting silver exports. They formally classified it as a strategic material, just like rare earth.
That is a huge calculated move. And why does it matter so much? Because silver isn't just for jewelry. It is absolutely mission critical for U.S. industry and defense.
Right. Solar cells, high-performance batteries, medical instruments. China is a major producer with massive reserves. By restricting the supply, they're turning a market into a geopolitical weapon.
And we're already seeing the panic. There's a Canadian producer, Kuya Silver, that reported being approached by Chinese and Indian buyers offering $8 to $10 above the market price for physical silver.
That one anecdote tells you everything. It's a scramble for supply.
So what's the Western response?
They're racing to build these domestic mine-to-magnet supply chains. The US, the EU, Australia, they're all trying to break China's dominance. China controls, what, 90% of rare earth magnet manufacturing?
And we're seeing real money being spent. Neo Performance Materials opened a factory in Estonia, and the Department of Defense just gave a $620 million loan to Vulcan Elements in North Carolina to jumpstart U.S. production.
It's the government directly injecting capital to fix a huge vulnerability.
Now, switching from critical minerals to energy, it's a completely different story.
Totally different. Oil had a brutal 2025. It lost nearly 20%. It's a story of oversupply just outweighing all the geopolitical risks, even strikes on Russian infrastructure.
And the policy clash is front and center in renewables. Orfosted, the world's largest offshore wind developer, is now suing the U.S. government.
Suing them over the suspension of their $5 billion Revolution Wind project. And the reason for the suspension? National security concerns.
This clash between deregulation and large-scale climate investment is becoming incredibly messy and expensive.
Yeah, that lawsuit just highlights the deep policy uncertainty.
Speaking of large-scale investment, let's move to our third segment with a huge corporate shift. The quiet end of an era at Berkshire Hathaway.
It is historic. Warren Buffett formally ended his 6-decade run as CEO, handing the keys to Greg Abel. Class A shares dipped a little, 1.4% on Abel's first day.
And even though Buffett is still chairman, he made it clear. Abel will be the decider on how to spend. What is it?
A record $381.6 billion in cash. Just a colossal amount of money now in the hands of a new decision maker.
Okay, let's look at the auto industry, which just perfectly illustrates this policy tension we've been talking about. It's got a real split personality right now.
It really does. On one side, you've got the muscle car revival. Stellantis is bringing back the 777 horsepower Ram TRX V8 pickup, a $100,000 truck.
And they're openly saying it's because of fewer federal emissions regulations. It's a direct corporate response to that policy shift.
Then on the other side, the pure EV market is seeing this massive competitive shift. Tesla reported Q4 deliveries that missed estimates. They were down 16% year over year.
And the EV crown has officially changed hands.
Yep. China's BYD is now the world's top EV seller. They sold 2.26 million units, up 28%. It just signals that the global EV market is maturing way beyond a single U.S. player.
And moving to retail, we saw policy relief give an instant boost to furniture stocks. President Trump delayed higher tariffs on things like kitchen cabinets and furniture for a year.
And the market reacted instantly. RH, which had a terrible 2025, rose 8%. Wayfair was up 6%. It just shows that for these companies, a specific import duty can be the single biggest thing that moves their stock.
And a quick fun one, the airline class wars are heating up. Airlines are all in on premium travelers, new first-class cabins, exclusive lounges.
But they are getting much stingier at the back of the plane. American Airlines just cut frequent flyer miles for basic economy. And Southwest. Southwest is ending its famous cattle call boarding process. They're moving to assigned seating.
Wow, that's the end of an era right there. That brings us to our final segment, and this is probably the most critical for you, the listener. Several major policy deadlines hit on December 31st, and they've created some serious tax traps for 2026.
We have to start with retirement tax traps. Specifically, required minimum distributions, or RMDs. For retirees, usually 73 and older, these are mandatory withdrawals you have to take by December 31st.
And people are calling missed RMDs a billion-dollar mistake. One study estimated it could cost investors up to $1.7 billion a year in IRS penalties. Why so high?
Because the penalty is brutal. It's 25% of the amount you were supposed to withdraw but didn't.
25%? Ouch.
And the key takeaway here is that RMDs are just the government finally collecting taxes it let you defer for decades.
Mm-hmm.
This isn't just an administrative slip-up. It's a massive, punitive tax bill. You have to be proactive.
Even more concerning, I think, for a younger demographic is the student loan tax bomb, the law that shielded student loan forgiveness from taxes. It expired on December 31st, 2025.
This is a catastrophic policy shift for people who made financial plans based on that protection. Starting this year, 2026, any loan forgiveness you get under an income-driven repayment plan now counts as taxable income.
Let's put some numbers on that. The average balance for people getting forgiveness under these plans is about $57,000. So for someone in the 22% tax bracket, that's an immediate tax bill of over $12,000.
It's a massive, unplanned liability for people who can least afford it, often public service workers.
Okay, on a slightly better note, there is a new rule for long-term care planning, but it comes with a big catch.
Right. The Secure 2.0 Act now lets you take penalty-free 401k withdrawals for qualified long-term care insurance premiums, up to $2,600 or 10% of your balance.
Penalty-free sounds good, but what's the strategic trade-off here?
It's twofold. First, the withdrawal is still taxed as ordinary income. But more importantly, you are sacrificing decades of tax-deferred growth. And with the cost of a nursing home room now over $111,000 a year, advisors are questioning if it's really a good idea to raid the very savings you'll need to pay for that care later.
Okay, let's pivot to housing. We're seeing a bit of an affordability paradox.
Yeah, affordability technically improved. Mortgage rates dropped. The 30-year fixed is around 6.19%, and price growth slowed way down.
But the paradox is the down payment. The typical buyer now needs 7 years to save up enough, which is double what it was before the pandemic. So the barrier to entry is still incredibly high.
Exactly. Heroic saving efforts are required.
And finally, a quick note from the travel world. Get ready for credit card devaluation. The popular Capital One Venture X card is getting a major downgrade on February 1st. They're cutting complimentary lounge access for authorized users and guests.
So you have to use those perks now. But if you're looking for hidden value, the U.S. Bank Altitude Connect is a rare bright spot. It's a no annual fee card with 4 priority pass visits.
And crucially,
Those passes still include the restaurant credit, a perk that almost every other premium card has gotten rid of. It shows that value is out there, but you have to know exactly where to look.
that was a deep dive into a really overwhelming start to 2026. What we've really unpacked is this powerful friction between policy and market reality. Deregulation lets the RAM TRX thrive, but halts a wind project. Geopolitics turns silver into a weapon.
Absolutely. The structural risks are tied directly to governance, whether it's the division at the Fed or these new unforgiving tax policies hitting millions of people. In this environment, knowledge is knowing where that risk and hidden value lie.
So here is a final provocative thought for you to chew on. We've established that geopolitical tensions are driving massive price increases for critical materials like silver and rare earths. Now that policy figures have successfully challenged large-scale renewable projects and championed the return of high-horsepower V8 engines, what unexpected industrial resource, maybe specialized steel, oil field equipment, or even just clean water, will the world suddenly realize it needs to scramble for next? And what will that scarcity do to prices?